Okay, welcome back to another session. I'm going to be teaching you guys exactly why you should be investing into the stock market every day. And then on top of that, how to value a company so that maybe instead of investing in just the S&P 500, you can do what I do, which is buy a ETF, short-term ETF for a bond, like CLOI, for example, it's a short-term bond ETF, and invest in 7 to 10 very strong companies that over the course of 5 years have strong future cash flow. Now, to evaluate a company, there's something called cash flow, okay? But most people call it CF. Now, I don't want you guys to think about it too much. Just think about it like, would you give your cousin $1 million to run a lemonade stand if he's only making $10 a day? Probably not. But would you give Apple $1,000 if they're making millions of dollars every single day? Probably. Now, the thing that you have to be careful with is sometimes, especially like right now in this economy, you're going to see that a lot of stocks are very high in price. They're very inflated. We're in something called a bubble right now. Now, the Fed is cutting interest rates. You have PE ratios going through the roof. So there's a lot of uncertainty as to where the market goes. So make sure that you follow these steps correctly so that you don't make the same mistakes that I did. If you don't know who I am, my name is Aiden Hamlin. I have 7 years experience trading and investing inside of the stock market and crypto market. Anything I say is not a suggestion for you to buy, hold, or sell any stock or cryptocurrency. My main goal is to make sure that every middle-class American gets to 6 figures. And there's an easy way to do that. Easiest way to do that is when you're starting off with stocks. If you're not even investing in stocks, you're already making a mistake though, right? Not investing into the stock market means you're leaving a large sum of money on the table. If you don't invest for 10 years, you literally just costed yourself your entire savings times 2. So imagine in 10 years, instead of putting your money into the bank, you actually just put it into the S&P 500. Instead of having $50,000 saved up over the course of 10 years, you could have $100,000 over the course of 10 years. Doing the exact same thing, you're just putting money away, putting it to the side and not looking at it. You're leaving a lot of money on the table if you are not investing into the stock market. Now, when you first get started, there's low risk, medium risk, and high risk portfolios that you can set up. Low risk is pretty much just the Warren Buffett method where you have VOO, that's 90% of your portfolio, and then a short-term bond. A lot of people like BND. I actually like CLOI, and I use 10% of that into my portfolio, right? Now, that's a low-risk asset portfolio. You have the S&P 500 in there, which is just a culmination of the top 500 companies on the New York Stock Exchange. And then that other 10% is a bond, which pays you a generous dividend of 6% a year. And it's just a good way to offset risk because it's not correlated to the actual general stock market. Now, you also have medium risk, okay? And medium risk, how that works is you have a little bit more exposure to the stock market and a little bit less exposure to the bond market. And medium risk could look like a lot of things. You could have more exposure to tech. You could have more exposure to gas and oil, whatever the case may be. Personally, me, if you wanted to open up a medium risk portfolio, just based on the fact that the president that we have right now, Trump, you're probably going to want to be into US oils as well as some type of defense stock. I like LMT, Lockheed Martin, especially with the Iran sanctions that are going on. I try not to get too political when I talk about money, but there is a lot of money to be made inside of politics. So typically when a president whispers, hey, Iran this, Iran that, Israel this, Israel that, we're going to be talking to Russia, that's whispers for what the next 4 years is going to look like. Similar with the Russia-Ukraine war. There was a lot of money to be made in oil during the Russia and Ukraine war. I capitalized on it, as well as many other people that I know that are into stocks. So I would say if you're doing a medium risk portfolio over the course of the next 4 years, not 5, but 4 years, this presidential term, I would say VOO, as a starter, having that at 75% of your actual stock portfolio, and then also exposing yourself to QQQ, and that's at 10%. And then other than that, you also have the short-term bond that you're going to be in, which is CLOI. I love CLOI. It's very hard to beat CLOI. And you're going to have 5% of your money into there. And now, as for the oil stocks that I was talking about and the defense stocks, there are ETFs and stocks that you can choose when doing a long-term investment or a long-term portfolio. There are two ways that you could go about it. If you want to expose yourself to more risk, XOM, which is Exxon, that is a gasoline petrol company. That is a good one to use for US oil. And as for defense, Lockheed Martin is also a very solid choice. They have great cash flow. They typically always get some type of contract with the US military. So you could do however you want to set it up. You could do 5% LMT, 5% XOM, however you want to set it up. Me personally, I like XLE. That is an ETF for American gas companies. And then you also have, or general gas companies, I think they have some that are not American. And then you also have defense. Now defense, that could be LMT again, or it could be an ETF that holds LMT. So I don't have any on the top of my head, but defense ETF would also be in that 5%. Again, anything I say is not a suggestion for you to buy, hold, or sell. I'm simply telling you what I would do for myself or do for somebody that I cared about if they had questions about how stocks work and what they should invest in first. Now, moving into higher risk, okay? This is where you actually start to take a select few companies and invest into them long term. So if you wanted to talk about higher risk, right? High risk, it doesn't necessarily mean that you are going to see a large downturn. It just means that the probability of a higher downturn than the previous options is present. So with the low risk portfolio, typically your max drawdown is like 10 to 20%. Like worst case scenario, like war, nuclear war, Russia, Ukraine. That is the max drawdown that you'll see in your portfolio, and you'll see it come right back up. Now, high risk, that's something where you could see anywhere from a 35 to 40% drawdown if you don't have stop losses in place, which I'm going to get into next. High risk, VOO, you're literally not even going to have that much of it. You're going to put 25% of your money into there. QQQ, same thing, 25%. And now this is where you actually get into learning how to manage your own portfolio. So learning how to manage your own portfolio would consist of something like this: Microsoft, Tesla, Meta, etc., etc. Max I would say you should use for this type of method is possibly 7, maybe 10, but doing something where you have a setup where you have Microsoft, Tesla, Nvidia, Meta, Google, Amazon, United Healthcare is actually a very strong pick for me right now over the course of the next 5 years. Doing those types of companies and making sure that they aren't that similar at all, it does typically produce a lower setup risk, but also a higher reward. Now, when it comes down to investing into stocks, there's something called the stop loss that you want to make sure that you have here. So when you're investing long term, your question might be, well, how do I make sure that, if I'm not looking at it, it doesn't just go down to zero right away? One, very low chance of that happening if you're investing in the companies that I'm saying are the obvious choices here. But also, two, you want to set up a stop loss so that way, if it goes down to that level, you're already comfortable with the amount of risk that you're taking on. So let's say that you put $100 into ABC stock, right? ABC. If the max amount of money you're willing to lose on ABC stock is $15, you would simply just set up a stop loss 15% from that. So the max amount I'm willing to lose is $15. You can set up your stop loss to say, once I start losing more than $15, sell this stock. Now, some of the reasons you might want to do that is, let's say that you have a long-term hold, you've been holding a company for 1 to 2 years. You might want to protect those profits. You don't want to lose out on them. You built them over the course of 5 years. So setting up a stop loss where you say, hey, if this stock goes down X percentage, sell it. A typical rule that you want to make sure you're following, though, is the newer you are to the market, the higher the chance that you're going to see a 5 to 10% drawdown. It's the consistency of the investor that reduces the amount of risk that they are assuming. The more skin that you have in the market, the less likely it is for you to see a significant drawdown. Now, moving into my last part, how do you value a stock? This is a method of mine that I've adopted and I truly love. I think it works only if you plan on investing long-term, though. If you're not here to invest long-term, there are other videos that I am going to be making, but this is a long-term portfolio video. So when you're selecting a stock that you want to put into your long-term portfolio, like why would Aiden choose Microsoft, or why would you choose Tesla? Like what's the evidence behind that choice? You have something called DCF. DCF is essentially going to tell you the discounted cash flow amount or the value of a company based on its current cash flow, its projected future cash flow, as well as its current price. I'm going to show you what that looks like now. So I did an example with United Healthcare. I really like United Healthcare because after the Luigi Mangione trials, you saw a massive dip, but it's still a very strong company with very strong cash flow. I'll show you why. Now, to calculate discounted cash flow, you essentially take the equity value, and they currently have a 718.86 billion equity value. And you want to subtract the debts that they have, and they have 47.2 billion in debts, meaning that they are currently valued at an equity standpoint. And if you don't know what equity means, it simply means that if they had to sell everything that they had right now, how much money would they get for it? If they sold everything regarding their company, if they tore it apart, what would it be worth? So their equity value is 671.66 billion. Just keep that number in your head. Now, once you get to that, just gonna erase this here. You're going to take the 671.66 billion and divide it about the outstanding shares, meaning the amount of shares that people have not bought into United Healthcare. So right now, their intrinsic value per share is 671.66 divided by 905.67 million outstanding shares. So 671.66 billion divided by 905.67 million. Billion. That amount equals to $741.56 per share. Meaning each share is worth $741.56. From an equity standpoint, this is important because in the general stock market, it is actually only going for $358.77. Now, why is that? The reason why is because the stock market is a marketplace. The same way that Pokemon cards are just pieces of paper with Pokemons on them, people give them a value because of how other people treat them as a tangible item. So Pokemon cards, for example, went through the roof in price because more people started to seek the value in them. They started to treat them like a collector's item. Companies are the exact same way. If you see that a company just had a huge scandal, you're most likely not going to want to buy into their stock because you know that they're about to get sued, they're about to lose money. Think of it like you're a big millionaire and somebody asks you for a loan for their business and you look at their cash flow statements and they've been losing money every single year. You probably wouldn't give them a loan for $1 million. But if you see a company that is consistently making profits and substantially strong profits, and they ask you for $1 million loan, you're probably going to consider that more than the other option, than the former option. Meaning, right now, from an equity standpoint, this company is worth $741.56 a share, but because of the Luigi Mangione trials and the murder of I believe he was the CEO or the CFO of that company, of United Healthcare, because he was murdered, their stock price went down because it's a major scandal, it's uncertainty, nobody knows what's going on. But the man who stepped in, the new CEO, was their previous CEO, who also took them from the exact same depths when their stock was down 25%. This exact same CEO, I wish I remembered his name, took their company back up into the green. Now, this is why I like United Healthcare. The current CEO that you have, he saved the company back in the 90s. You also have a setup where intrinsic value from an equity standpoint, the stock is $741.56. That's how much it's worth equity-wise. And because of fear and the Luigi Mangione murdering, you see that the current price of United Healthcare is only at $358.77. So using the Warren Buffett discounted cash flow method is actually showing us that there is a large potential for an upside in the next coming years. The growth rate over the course of 5 years is 106%. However, that means that it's going to roughly perform at 13% a year. That is how you value a company. If you don't know how to value a company using this method, you can ask an AI tool to do it for you. You can ask Grok, ChatGPT. You could use a calculator online. There is no excuse in today's economy as to why you cannot make you money in some type of way, shape, or form, especially in stocks. If you're not investing in stocks at all, you're making a huge mistake. AI and the free information era that we're currently in right now give you such a high advantage into winning, but because you are too inconsistent, you're never going to see that upside. Buying a stock every once here and there, it's not going to yield you a large return. You're going to put in $100 over the course of 6 months, you're going to make $5, and you're going to be like, whatever. If you invest daily, every single day, without missing a beat, staying consistent, making sure that you are hitting your metrics, you're setting your stop losses, you are set up to be in a position where it is very hard to fail, and it is very hard to not hit 6 figures in 5 to 10 years. You're not going to have 6 figures in 5 to 10 years anyway, so you might as well start investing because you're leaving so much money on the table.